Hello, guys. Thank you for coming to my webinar. Saturday, July 6th, 2024. We're going to discuss about financial controlling and critical decision making. How can financial controlling help our company, help ourselves, make better informed decisions that actually enable the company to scale upwards, to improve profitability, improve sales, improve cash flow. So, what's my objective? Why am I doing this? I'm doing this in order to be able to help solopreneurs and people that are starting their businesses to make rational decisions that will help them reach their next level of activity. I'm trying to help CEOs of small and medium enterprises increase their profitability and cash flow, thus growing their company to more sales and again better cash flow. And I'm trying to help CFOs, VPs of finance, members of directors of large companies, multinational maybe, to be able to have more accurate, reliable, validated, and relevant information into making proper decisions. In the particular case, we're talking about strategic decisions, investment decisions, decisions that will affect the course of the company in the coming years. Now, throughout my career, for more than 20 years, I have witnessed small companies that managed to grow and thrive, large companies that were once giants to being getting crushed in zero time. Of course, in both cases, there are many parameters that led to this outcome. However, there is one common pattern in most of these cases. When the companies managed to thrive and grow, they had established a solid, strong, down-to-earth decision-making process that was irrelevant of emotions, that was irrelevant of thinking of if someone had the instinct or the hunch, or if someone was related to someone else, or if someone wanted to have a luxury item such as a golf club, car, or some other thing. The companies that managed actually to grow, they had a decision pattern of creating and actually choosing the projects that had less risk, more expected return in less amount of time required. And in most cases, these investments were very close with their current scope of action operation. Now, let's see what we have to avoid. We have to avoid the dark cold room. And this means, first of all, avoid window dressing and financial statements. The investment and the banking community have professionals who are highly skilled. Many of them are certified. They are experienced with at least 10 years experience. Of course, in some cases, their experience expands much more than this period of time. And they can read between the lines. They can read the financial statements, they can understand what you are trying to hide or what you're trying to show. And they have their own ratios, they have their own adjustments that they do, they can ask for explanations. It's not easy to hide, it's not easy to try to show a picture that is different from the reality. Assume that they will know. Avoid business politics when making investment decisions. This is critical. The company's investment decision, whether you are a solopreneur, whether you are a CEO of a small medium enterprise, or whether you are a CFO of a large multinational company, you must make sure that the people that do actually make the decisions, they make the decisions on a rational basis based on accurate, valid, relevant data. And the decision-making process itself actually ends up to a decision that is critical and vital and relevant to the scope of the company. There is scarcity of resources. If your company chooses to invest in investment opportunities that do not produce revenues, profits, cash flow, then this will have two unpleasant consequences. First of all, most probably your business will lose money. This means that you will not be able to invest when you will have the opportunity to invest in an investment that is most probably very close to the reality that you live and the business that you want to accelerate. Second, some of your competitors most probably are highly experienced and know about these tricks and gimmicks and know what to avoid, and they will avoid them. So in essence, when you make a bad decision, you give the ground, you give the competitive advantage to your competitor to gain money from your bad decision. There is no need to do that. The last thing, avoid leaving blank space in your work. If you don't set up proper policies and communicate them to your team or teams, well, make sure that one day your company, your team will have a lot of problems, and one of that will be cash flow. If you don't have policies, if you don't implement these policies, if you don't have operational plans, if you don't have standard operating procedures, if you don't guide your people what to do or what not to do, well, the outcome will not be pleasant. Step number 2, policies for sales. This is critical. You have to make sure that the salespeople understand that sales is not completed until the money is in the bank account of your company. Now, you want to sell on credit? Fine, a lot of corporations do that. But be sure that you understand the risk that is involved. Be sure to understand that the salesperson is committed into bringing the cash to the company. The salesperson is obliged to understand that part of a sales offer is credit terms. If there are no credit terms, there's no sale on credit. It's something else. How will you communicate your client? How will you ask your client for money? Your client will say, no, that's not what I agreed. What did you agree? The client will assume whatever he wants. Maybe the client will say that I agree that I will pay when I get paid. Okay. And when do you know when the client gets paid? Now, always contact and follow up with the client after selling. Assume that you have already communicated to the client that there are credit sales terms and there are, let's say, 60 days after delivery. Okay. After issuing an invoice, after delivering the product, call your customer. Make reconciliation. Make sure that the client has booked the invoice. Make sure that the client has received the goods. Make sure that the client understands that the client has 60 days to pay you back. Leave no room for misunderstanding. Every day that you let this go by, you lose money. Always remember, credit, sales on credit has risk. Try to control the risk. Try to control and minimize the risk, because if you don't have receivables, if you don't have cash from receivables, you are losing cash flow. Third, set real clear rules about when a credit sale is considered as an expense, that is bad debt. What does this mean? Okay, you have agreed with 60 days, you have communicated with the client a number of times, and the client says, yes, I will pay you in 60 days. 60 days come and the client doesn't pay. Okay, how much time does a client have? How much time do you have? How much time do you have before you consider to be a bad debt? How much time do you give the customer before the lawyer comes in? These are critical questions, and always have in mind, booking accounting entries is one thing. Depicting the reality in the financial statements is a completely different matter. So, as we're trying to depict the actual economic performance of the company in the financial statements, whether we're talking about internal financial statements for, let's say, management reporting or not, be sure to understand that there must be rules to follow by everybody. This means that everybody must understand that the client has 30 or 60 or 90 days after the given period before the sale is considered to be bad debt, which means that the company understands that it is highly unlikely to recover the money from the invoice. So what will this effect have on sales team, on accounting team, on the cash flow? When will the board of directors will be informed? Will be the lawyer informed? These are critical matters. Now, there are a few things that we need to, let's say, it's credit policy, sales credit days, and bad debt rules. It's a great opportunity to contact me to discuss about these things and how we can implement this to your case. Step number 3, inventory policies. Now, this is a major issue, inventory. First of all, we have to establish a policy that we evaluate the inventory based on the actual turnover of the items. Now, there must be a policy that says if an item doesn't sell within 30, 60, 90, 120 days, considered to be a slow-moving item. What does this mean for the company? What does this mean for the profitability of the company? How much, when will this be expensed in the accounts, and at what portion of the face value of the inventory? That's the first thing. And the second thing is that when you are talking about slow-moving inventory, you have to make sure that every department is included in the process. This means the purchasing manager who actually made the purchase, the sales department who was informed that the item will be available to the inventory, why did this item did not sell, and of course the accounting department to understand why this happened and when did, under which terms did they actually release the order to the factory to purchase the item or to make the payment. Another point is establish discount policy for fast-selling, slow-moving items. You have a slow-moving item. This means that you made a bad decision somewhere earlier. Okay, this doesn't matter. Make sure that you get rid of it as fast as possible. How fast can you sell it? For which percentage of the face value of the inventory? Now, we're not talking about making a profit. We have now a different strategy. This calls for a stop-loss strategy. We say, okay, we paid €100. I'm saying we're supposed to sell it for €300. Okay, we did not. Can we sell it for 200? Can we sell it for 120? And how much can we sell it in order to get our cash back? You need cash. You need cash for your company to be able to live, to pay expenses at the end of the month. Now, the third point, and this is another critical one, you must have a policy for certain criteria when making purchases. This means who is actually authorized to make purchases? Up to what amount? Up to what terms? What does this person need to have as a prerequisite information before making the purchase? Okay, you have a person, let's say Tom, that Tom is the vice president of logistics or purchases. Okay, and has the authority to make orders to factories. Okay, what does this? You must think from the end backwards. In the internal audit process, this person must present some information when making decisions. What information will this person have to present? This is very interesting. Now, there are some interesting points that I strongly believe that we should contact in order to discuss for your case. Policies for inventory countdowns. How often do you need to have a physical countdown? To which items? To which factories? Second point, Policies for defining slow-moving items. When and under what circumstances do you define a slow-moving item as such? And how do you expense it? And how do you report that to the board of directors? And who is accountable for this? Third, approval policies. Who has authority to make purchases? Up to what amount and with what criteria? All these matters are very interesting subjects. Step number 4, investment policies. Now, this is critical because this usually affects large amounts of money and a large amount of time in order to be able to have the money back into the company. So, financial controlling, how can help? First of all, set up investment policy. This is critical. You must have a clear-cut investment policy defining all details about investments, from the items that you may consider, from the valuation methods, from the risk analysis, the approval policy, to the risk that you consider reasonable to undertake. This is critical. Now, the second, when deciding the investment and the vendors, you must have an operational plan. This operational plan must be already pre-written and pre-approved by the board of directors or by the management. But it must be done beforehand. You must have time to go through the details before reality comes in. If you don't have this, it's going to be too late. You must have already set up some sort of contracts. In the contracts, you must have payment terms. You must have provision for validation of work done and received, and a number of other details that will save your life when actually the investment starts. And finally, have a policy to validate work received, reconcile this with the accounting entries, and arrange payments accordingly, which means that you have a project to construct a working site or purchase a new equipment that will boost profitability and production by 25%. That's great. Okay. When did you receive it? When did you install it? Who has the responsibility for delivering it to you? Who has the responsibility for setting up this to you? When do you have the liability to pay the vendors or the contractors or the subcontractors in each case? And of course, we have the other side of the coin, which is when this is going to cash flow for you. And this is a great matter. This is why I strongly believe that it's a great opportunity to discuss and contact me about these wonderful ideas. Always have in mind that you need to cash flow. If you don't cash, then you are closer to a very bad outcome. So avoid the dark and cold room. Try to cash flow. Try to make everyone understand that the objective is to cash flow. The objective is to have more cash inflows than cash outflows. So we are here to help you grow your business, invest your valuable resources to the collaborations that will bring you value to you and to your vendors and to your clients. You deserve to have a tool that will guide you into making stronger, more effective investment decisions. We are here to help you. You can email me and you can message me via LinkedIn. Thank you so much for your time. I hope that you enjoyed it. I'm here for whatever else you are willing to discuss.